Good morning, Bill Gross here, and I wanted to share with my Facebook friends and family and colleagues some great information I got yesterday. I'm affiliated with EXP Real Estate, which is a nationwide real estate company. It's publicly traded. We have our convention yesterday, which had been scheduled in Orlando. Instead, it was done virtually in a virtual convention. But there's a great presentation by our CFO on the market conditions and explaining what's happening, what's going to happen in the future. And I wanted to share some of those highlights with you. I think you'll really enjoy them. So here is the information that I got that might be of value to you in terms of my market highlights. Home prices are probably going to be higher year over year. They're projecting, this is based on data they got from Zillow in particular, that home prices should be more next year, year from now, than they are now, slightly. One of the driving factors is that mortgage rates are low, and that's going to cause continued demand. Um, Over half of homes sold in March were on the market less than a month. So March was red hot pre-COVID, and so that's the demand they see as being there. More listings will come in the market as the economy steadily reopens. So as the market reopens, house come to the market, there'll be more sales. Now the challenges are pending home sales fell 20% versus last year in March. So the second half of March was COVID and the market plummeted. Inventory for homes in March was lower than last year. I'll show you the details. There's downward pressure on pending sales and listings that continued in April. And the timeline for opening is unclear. That's even as of today in Los Angeles. We have no idea what's going on. So let's look at the data. New listings. You can see that as the COVID started March 17th, 18th, in this period here in California, right? We were told, well, listing activity is still good, and it was, but you can see it just fell off the table here, continuing through April 21st. So while initially the reports were, oh, the market's still holding together, sellers said, whoa, I don't want to sell my house and pull them off the market. And that caused buyers, you can see there were 40% less houses to see. Obviously, buyers would be less interested in what's on the market. And that translates into pending home sales, same thing. Through about March 30th, home sales were still flat from year over year. They were on pace way over last year, 20% higher, 30% higher at the beginning of the month, end of February. We were on a tear until the COVID started, and it's hard to say when it started having its effect, but certainly by March 17th, we were still up year over year. And then you can see it fell off the table. Pending home sales have dropped about 30 to 40% below last year's numbers. But the good news is it's starting to come back already. Now this is nationally. But you can see that we went from a bottom of maybe 35% off to about 27% off. Now the data suggests that people are delaying decisions, not abandoning. So for example, how has the COVID changed your attitude regarding buying a home? 42% said they're just delaying their choice. And while 17% said they stopped looking, another 16% said no change whatsoever. And 12% are continuing while they're at home. So you have 12 plus 16 plus 42, really not all affected by the market. And so 5% are out of the market indefinitely, and 17% have stopped for now. So about 22% have come out of the market. That's consistent with the drop in pendings. But the vast majority are still interested once things get a little more settled. On the selling side, how's COVID changed your attitude? 51% decided just to wait. Half the market of sellers say, well, we'll just wait till there's a better market. And then you can see that another 6%, no change in attitude. Now, 17% have stopped and 7% have given up. So again, about 24% are out of the market right now. But the vast majority are just delaying their decision. And that's good news, I think. So you can see how regionalized it is. In Austin, they're off by 50%. Houston, 22%. Charlotte, 35%. Los Angeles, we're off by over 50%. This is new listings year over year. Now, where's the bottom? This is the magic question. This is a great chart. I actually had an email last week. I'm going to send that again this week. So we started the COVID around February, March period. And then the activity dropped. The question is, how far will it go? Most likely scenario is the drop will continue in home prices, they most likely will fall 2 to 3%. So most likely scenario is around November, prices will still be around 2% below where they were pre-COVID. What does that mean? So a house selling for $800,000 in February would drop to a bottom and stay at about 782. Not that far off, 2 to 3%. 782 to 776 from 800,000. So about 3% drop. So I've seen buyers demanding 10% drops and sellers resistant. Now, the pessimistic view is the economy gets worse and will go down see as much as a 4% drop in value. Optimistic is we back to where we were next year come April, a year from now, and then we'll continue on a tear. And you can see even the most likely scenario is we'll be back up and running next year come end of the year, October, November 2021. Here's the sales, now that's prices. Here's the sales volume. We dropped tremendously, about 40% as we saw come April, May. How quickly do we rebound by unit count? Well, most likely scenario is we will still be below where we were even next year. And that's where the people who decided not to participate are out, and the ones delay won't catch up yet. Even the most optimistic scenario says we won't catch our volume until the end of next year. Pessimistic volume is a lot worse. And this is why you're going to see so many real estate companies consolidate. Because even a year from now, they're going to be below where they were, and margins are so thin in real estate and related companies, they can't afford to survive unless they consolidate, cut their offices in half, cut down personnel. Existing home sales transactions for the year are projected to be 4.54 million, down about 13, 14, 15% from where we were last year and the years before. So a big decrease in units. Home buyer demand had been dropping from 2018, 2019. In the first quarter, down to 10% of prospective home buyers were planning to buy in the next 12 months. So that's a long-term trend, it's a different issue. Now here's the good news why it's different than last time. Just because we have a drop in volume and drop in prices somewhat, doesn't mean we'll see the 40% drop in prices that the buzzards overhead are looking for. And here's three factors to look at. Shares of homes with less than 10% equity. Last year, last cycle, 2007, 14.5% of houses had less than 10% equity in them, meaning at a 10% drop, they were upside down. At a 20% drop, they were well upside down. Now that number is less than half, 6.6% as of February. Subprime loans, last time around, we had 5.1 million and another almost 13 million ARM mortgages. And this is where the combination of the drop in equity and those mortgage hits, meaning the payments are going up, caused sellers to despair and walk from their houses. Today, we have 1.9 million subprime and 3.2 million ARM, total about 5 million, or about a third of last time. So we have half of the people with equity issues and a third of the people with future payment shock issues. And that's why you actually see sellers in the wholesale in mass all at once turn over the keys to the lender and walk away. More likely people try to find a way to work out of it. That's not even discussing whether the government's getting involved in helping people. So here are the takeaways. The housing market is resilient with good underlying fundamentals. Unlike last time, the market's in good shape overall. Second, indications are that listings will return when the economy picks back up again. People will come back to the market. Three, the data suggests that while we're under pressure, we see more of a check mark recovery, moving up more quickly, whether it be the optimistic or even the most likely scenario, a fairly quick return, maybe a year at most. Buyer demand is consistent through these circumstances. Some are holding off, waiting to get some certainty about going forward, and then we'll re-enter the market. And our company is really well positioned. We're a virtual company, and this was done by my company's CFO. But he's saying that certain companies are prepared for these things, and we as a corporation, we have no corporate headquarters building. We have no, we're right-sized staff-wise. Our recruiting is up, not down. So those are key things. Great quote from Winston Churchill: if you're going through hell, keep going. So what does that mean? In business, if you're having a tough time, keep pushing through. Don't stop halfway and get burned. Here's another important finding. This is from an amazing survey done by the IBM Institute for Business Value. And what they found, a survey of 25,000 people, said 75% of respondents indicate they like to continue to work remotely, at least occasionally. And over half would like that to be their primary way. Now, this speaks horribly for the office market. Because if you own office space, half the people would rather not be there. And I think we're getting statistics coming out now that companies working remotely have increased productivity, not decreased. Even with all the uproar and the crazy circumstances of most people's initial change to remote working, companies are still more productive. And those two combinations are going to change the way offices work going forward. And so that's what people want. So anyhow, that's my market update. This is information from the eXp Shareholders Summit, and they got the data for the most part from Zillow. If you have any questions, call me, text me, email me. I'd be glad to help if I can. This is Bill Gross. Thank you so much.